The financial world is in for a wild ride, folks. The Oracle of Omaha, Warren Buffett himself, has just made a move that has everyone talking. Wall Street is buzzing with speculation and analysis, trying to decipher the implications of his latest decision. Warren Buffett's Berkshire Hathaway recently released its latest 13F filings, unveiling its recent positions, and telling investors which stocks it bought and sold since the last quarter. According to the filings, Buffett has sold off his positions in two major S&P 500 ETFs, SPY and VOO. This move has left many investors scratching their heads. Is this the end of the world as we know it? Is the sky falling? Should we all be bracing for a financial apocalypse? The short answer is no, absolutely not. It's crucial to keep a level head and not jump to conclusions. Before you hit the panic button, let's break down what this really means, and more importantly, what it doesn't mean. Understanding the context is key. This isn't about a market crash or an impending economic disaster. It's about strategic repositioning. To understand this move, we need to delve into the investment philosophy of Warren Buffett, one of the greatest investors of all time. Buffett is renowned for his long-term vision, his patience, and his uncanny ability to see value where others don't. His strategies are often misunderstood by those looking for quick gains, so when he makes a move, it's important to pay attention, but it's even more important to understand the reasoning behind it. Buffett's decision to sell SPY and VOO isn't a signal of doom. Instead, it reflects his assessment of where the best opportunities lie. In this video, we're going to explore the possible reasons behind this move. We'll look at market conditions, potential new investments, and how this fits into Buffett's broader strategy. By understanding the context and the underlying principles guiding Buffett's decisions, we can gain valuable insights into our own investment strategies. So, stay tuned as we dive deep into the mind of Warren Buffett and uncover the wisdom behind his latest move. If you only watch one video today, make sure you watch this one, all the way till the end. Hit the like button, let's get 1,000 likes on this one. Share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. First things first, let's get one thing straight. Warren Buffett is not your average investor. He's not day trading on Robinhood or chasing the latest meme stock. This is a man who built his fortune by investing in solid, well-established companies with strong fundamentals. He's all about buying great businesses at a fair price and holding them for the long haul. Buffett's investment philosophy is rooted in value investing. He looks for companies with a durable competitive advantage, a strong track record of profitability, and a management team he trusts. He's not afraid to be patient, waiting for the right opportunity to buy at a discount to intrinsic value. And once he buys in, he's in it for the long game. Now let's talk about those ETFs. SPY and VOO are both exchange-traded funds that track the S&P 500, a broad market index of 500 large-cap U.S. companies. They're incredibly popular with investors, and for good reason. They offer instant diversification, low fees, and a way to participate in the overall growth of the stock market. Historically, the S&P 500 has grown at a rate of around 10% per year. For 2 years in a row now, its gains have been in excess of 20%. Betting on the market for the long haul has been an excellent strategy for investors to deploy. But if that's the case, why did Buffett sell his positions in those ETFs? But here's the thing, Warren Buffett has always been a big proponent of individual stock picking. He believes that by carefully researching and selecting companies, he can outperform the market over the long term. And let's face it, his track record speaks for itself. While he's recommended index funds for the average investor, he's always played the game a little differently. So if Buffett is not panicking about the market, why sell the ETFs? According to the 13F filling, Buffett's Berkshire sold its entire stake of 39,400 shares in SPY, valued at $22.6 million, and 43,000 shares of VOO worth $22.68 million. The sales occurred during a quarter when the S&P 500 gained 2.4% and finished 2024 with a 25% return. It may be tempting to think that Buffett is worried about the S&P 500 and that's why he's exited those holdings. But the reality is that they were never large positions for Berkshire to begin with. They didn't even account for close to 1% of the overall portfolio. It's like selling a few old shoes to make room in your closet for a brand new suit. The real story here is not what Buffett sold, but what he still owns. Apple, American Express, and Bank of America. These are just a few of the heavy hitters in Berkshire's portfolio. These are companies that represent the core of the American economy, companies with a proven track record of success and a bright future ahead of them. Buffett has also said that he doesn't place a lot of value on economic forecasts. Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future. Although some investors may be worried about potential trade wars and tariffs and their effect on the economy, Buffett has remained invested in the stock market for decades, during even more turbulent economic conditions. While Buffett says that investing in a diversified index fund is the best option for most people, he doesn't fall into that category. Buffett has become one of the richest people in the world, thanks in large part to his ability to find excellent companies to invest in. He doesn't need an index fund and can rely on his own stock-picking abilities. Although Berkshire exited its position in a couple of S&P 500 ETFs, that doesn't tell investors anything about what Buffett's thinking about the current state of the market. His investment goals are going to differ from those of the average individual investor. Ultimately, investors should make decisions that are appropriate for their own strategies and levels of risk tolerance. The ETFs Berkshire sold still make for solid long-term options for investors, but if you are comfortable with picking individual stocks, that may be a preferable route as well. Whatever option you choose, staying invested in the market for the long term remains a solid strategy, and Berkshire's latest moves shouldn't dissuade you from doing so. But wait, there's more. When we think of value investing, names like Warren Buffett and Berkshire Hathaway often come to mind. Their strategy is all about finding undervalued companies with strong fundamentals and holding on to them for the long term. This approach has made them legends in the investment world. Berkshire didn't just sell those ETFs, they made a strategic move that caught many by surprise. They also made a brand new investment in a company called Constellation Brands, ticker symbol STZ. This decision raised eyebrows and sparked curiosity among investors and analysts alike. Now, Constellation Brands might not be a household name like Apple or Coca-Cola, but it has a significant presence in its industry. They're a major player in the beverage industry with a diverse portfolio that spans various segments. We're talking about brands like Corona Beer, Modelo Especial, Kim Crawford Wines, and Svedka Vodka. These are names that resonate with consumers and have a strong market presence. This is where Buffett's value investing approach really shines. He looks beyond the immediate challenges and focuses on the long-term potential of a company. Constellation Brands has faced some headwinds recently. The pandemic, supply chain issues, and other external factors have created hurdles. Changing consumer preferences have also taken a toll. More people are opting for healthier beverages, and this shift has impacted sales. But Buffett sees something that others might be missing. He sees the intrinsic value in Constellation Brands' strong portfolio and market position. He sees a company with strong brands, a loyal customer base, and the ability to adapt to changing market conditions. And a management team that's committed to navigating these challenges. This is a classic example of value investing at its finest. By identifying companies with solid fundamentals and the potential for long-term growth, Buffett continues to demonstrate why he's considered one of the greatest investors of all time. So, here's to Constellation Brands and the enduring principles of value investing. Let's delve into the strategic moves of Constellation Brands, a company with a storied history and a promising future. We'll explore why this company has caught the eye of savvy investors and what makes it a compelling investment opportunity. Let's dig a little deeper, shall we? Constellation Brands, known for its diverse portfolio of alcoholic beverages, has consistently demonstrated resilience and adaptability in a highly competitive market. Their financial reports reveal a company that not only understands the market dynamics but also knows how to leverage them to its advantage. Constellation Brands has a long history of growth and profitability. Founded in 1945, the company has grown from a small wine producer to one of the largest beverage alcohol companies in the world. Their journey is marked by strategic acquisitions, innovative product launches, and a keen understanding of consumer trends. They've been around for over 70 years, and their stock has been a long-term winner. The company's ability to adapt and grow has been reflected in its stock performance, which has shown impressive gains over the decades. This long-term success is a testament to their strong management and strategic vision. Yes, they've faced some recent challenges and their stock price has taken a hit. Market fluctuations, changing consumer preferences, and economic uncertainties have all played a role. However, these challenges also present opportunities for savvy investors who can see beyond the short-term volatility. But that's exactly what value investors like Buffett look for. Opportunities to buy great companies at a discount. Warren Buffett, known for his investment acumen, has a knack for identifying undervalued stocks with strong potential for growth. His interest in Constellation Brands signals confidence in the company's ability to overcome its current hurdles and emerge stronger. The numbers tell a compelling story. Despite recent setbacks, Constellation Brands' financials remain robust. Their revenue streams are diversified, reducing dependency on any single product or market. This diversification is a key strength, providing stability and growth potential. Constellation Brands has a strong balance sheet with healthy cash reserves and manageable debt levels. This financial stability allows them to invest in growth opportunities and weather economic downturns. Their prudent financial management is a cornerstone of their long-term strategy. A history of paying dividends, which is a clear indication of their commitment to returning value to shareholders. Regular dividend payments not only provide a steady income stream for investors but also reflect the company's confidence in its future earnings potential, and a plan to return value to shareholders. Their strategic initiatives are focused on enhancing shareholder value through a combination of dividends, share buybacks, and strategic investments. This multifaceted approach ensures that shareholders benefit from both income and capital appreciation. They're investing in their core brands, expanding into new categories, and continuously innovating to stay ahead of market trends. Their commitment to quality and innovation has helped them build a loyal customer base and a strong brand portfolio, and adapting to changing consumer preferences. In an industry where consumer tastes can shift rapidly, Constellation Brands has shown an impressive ability to pivot and meet new demands. Their focus on understanding and anticipating consumer trends is a key driver of their success. Buffett clearly sees the potential for a turnaround, recognizing the company's strong fundamentals and strategic initiatives. His investment is a vote of confidence in Constellation Brands' ability to navigate challenges and capitalize on opportunities, and he's betting big on their future success. With a solid track record, a clear strategic vision, and the backing of astute investors like Buffett, Constellation Brands is well-positioned for a bright future. Their story is one of resilience, innovation, and strategic growth, making them a compelling choice for investors looking for long-term value. Now you might be thinking, why is Buffett buying Constellation Brands when everyone else is selling? And that's the million-dollar question, isn't it? The answer is simple. Warren Buffett doesn't try to time the market. He doesn't panic when stocks go down, and he doesn't get greedy when stocks go up. He sticks to his principles, focusing on finding undervalued companies with long-term growth potential. He's not concerned with the day-to-day fluctuations of the stock market. He's playing the long game, and he knows that over time, quality companies with strong fundamentals will prevail. He's buying when others are fearful, because that's when the best deals are to be had. Now I know what you're thinking. Should I be buying Constellation Brands just because Warren Buffett is? It's totally up to you. What's right for Warren Buffett might not be right for you. Your investment decisions should be based on your own individual financial goals, risk tolerance, and time horizon. But there's a valuable lesson here for all investors. And that lesson is the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies. That way, if one investment goes south, it won't sink your entire portfolio. So what can we learn from Warren Buffett's latest moves? First, don't panic. The market goes up, the market goes down. It's the nature of the beast. Second, focus on the long term. Don't get caught up in the short-term noise. Third, invest in what you understand. If you don't understand a company or an industry, don't invest in it. And finally, remember that investing is a marathon, not a sprint. It takes time, patience, and discipline to build wealth in the stock market. Don't try to get rich quick. Focus on making smart, informed decisions and let the power of compounding work its magic. Warren Buffett's recent moves are a reminder that even the greatest investors are constantly adapting to changing market conditions. They're not afraid to make bold moves, and neither should you be. But those moves should be calculated, strategic, and aligned with your overall investment philosophy. Stay informed, stay invested, and never stop learning from your experiences. If you want to take your investing to the next level, Forecaster is the ultimate tool I trust to find incredible stocks like these. Don't wait. Try it for free today. Just click the link in the description with my code, Galore10, for an exclusive 10% discount. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. What do you think of Warren Buffett selling off his SPY and VOO holdings? Let me know your thoughts in the comments. Don't forget to hit the like button. Let's get 1,000 likes on this one. Share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. And remember folks, there's always a bull market somewhere. Now go out there and make some money, smartly.